Have you ever wondered why the rich keep getting richer while everyone else struggles? It's no accident. The system is designed to benefit the wealthy, and it's all perfectly legal. From secret tax strategies to leveraging debt, these are the insider tactics you've never been told about. Let's get started. The first loophole the rich use is something called a tax shelter. Tax shelters are completely legal ways to reduce your tax burden. One of the most common tax shelters is your retirement account. When you contribute to a 401k or an IRA, you're shielding that money from taxes until you retire. The money you contribute often grows tax-deferred, meaning you don't pay taxes on any earnings until you withdraw the funds. Over time, this can lead to significant tax savings and allow your investments to compound much faster. The wealthy understand this and use tax shelters to their advantage. They often max out contributions and explore other legal avenues to minimize their tax liability. The rich understand that debt can be a powerful tool for building wealth. I'm talking about strategic debt, used to acquire income-producing assets or leverage investments. Think of it this way: debt is like a lever that can amplify your returns. Let's look at real estate as an example. Instead of paying cash for a rental property, a savvy investor might take out a mortgage. They can use the rental income to cover the mortgage payments while the property appreciates in value. This is called using debt to build equity. The wealthy often use debt to avoid selling their assets. They might take out a loan using their stock portfolio as collateral, getting the cash they need without having to sell their assets and pay taxes on the profits. By understanding how to use debt effectively, you can accelerate your wealth-building journey. The tax code favors investment income over earned income. The wealthy structure their finances to generate as much income as possible from investments. When you earn a salary, you pay income taxes, social security taxes, and maybe even state and local taxes. But when you earn money from investments like dividends or capital gains, you're taxed at a much lower rate. For example, if you made $100,000 from long-term capital gains, you'd likely pay a much lower tax rate, potentially as low as 0% or 15%. This is a massive difference, and it's one of the main reasons why the rich get richer. They understand that by generating income through investments, they can keep more of their hard-earned money. Even if you can't invest a lot right now, start small and be consistent. Every dollar you invest is a dollar that has the potential to generate passive income in the future. By shifting your mindset towards building wealth through investments, you'll be on the right track to achieving financial freedom. Let's talk about shell companies. Shell companies themselves are completely legal entities. They can be powerful tools for protecting your assets and minimizing your tax liability. A shell company is a company that exists only on paper. Its primary purpose is to hold assets such as real estate, intellectual property, or investments. If you owned a property through a shell company, your personal assets would be protected. The shell company acts as a separate legal entity, shielding your personal assets from any liability associated with the company. Shell companies can also be used to minimize taxes. By strategically structuring your business operations, you can potentially reduce your overall tax burden. If you're serious about building long-term wealth, it's worth exploring this option further with a qualified legal and financial professional. The final loophole we're going to discuss is real estate depreciation. Depreciation allows real estate investors to deduct a portion of their property's value from their taxes each year, even if the property is going up in value. It's one of the biggest tax advantages of investing in real estate. The IRS assumes that rental properties wear down over time. They allow landlords to deduct a portion of the property's value each year as an expense on their taxes. This deduction is called depreciation. Even though you're taking depreciation deductions, the property itself might actually be appreciating in value. This means you're getting a tax break while your investment grows. This depreciation deduction can significantly reduce your tax bill, freeing up more cash flow to reinvest in other properties or investments. It's a powerful tool that savvy real estate investors use to build wealth and minimize their tax liability. These 5 loopholes are part of the system that keeps wealth circulating among the rich. Now that you know them, how will you apply this knowledge? Building wealth is a marathon, not a sprint. Educate yourself, seek guidance from qualified professionals, and never stop looking for opportunities to grow your wealth. Subscribe for more insights into how money works, and share this video with someone who needs to see it. Let's level the playing field together.